Hello and welcome to Portfolio Matters, week 148. And Richard is back from his peregrinations on his mega yacht. And before we get going, he will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Apologies for last week, Keith. And what do we have this week?
Well, we've got a packed week this week as there's frankly not much economic news. So we've got a lot of special sections. And in particular, we're going to be going through all the oil production numbers for every major oil producer, as we do occasionally. And that's quite interesting, actually, particularly Nigeria and Guyana.
Mm-hmm.
But first of all, the news. Well, the big news this week is Nvidia once again beat expectations. Revenues rose an amazing 265% year on year, 22% quarter on quarter, and its shares surged 16%, driving the S&P 500 to new highs. Actually, the Nasdaq is not quite at a record high. In the Red Sea, the Houthis are being a total menace and have attacked various ships this week. The bulk cargo ship Rubaimar, which is, I think, British, but it was abandoned after a missile attack. In Ukraine, it's not going well, I'm afraid. Russia have captured the key town of Adivka, in part because we're not giving them enough ammunition. And finally, the People's Bank of China has cut its 5-year loan rate by 25 bips in order to try and stimulate the economy. You'll see in a second that the Chinese property market is not doing well. Okay, so this is Nvidia. Its profit margins, pause and take a look at this income statement. The profit margins are really amazing. It's a question of how long it can keep it up, but for now, its gross margin is 76%, operating margin 62%. Really astonishing numbers. And so the share price is going through the roof, but revenues have been growing even faster. Now, obviously, many things I've got wrong. I've also got this wrong, but when we talk about possible new bubble, I mean, I think the valuations of a lot of tech companies are way too high, but this is not like the dot-com bubble in that the revenue growth is absolutely there for Nvidia. It's been amazing. The question is, how long can it continue and what happens when growth slows? Now, this is market expectations for the number of Fed rate cuts. And since the start of the year, the market has really cut back its expectations for Fed rate cuts. It now expects 3 fewer rate cuts by the end of the year. And these are freight prices. The Houthi attacks in the Red Sea are keeping freight rates high, but they appear to have peaked for now. And finally, on the left, you have the Chinese 5-year fixed mortgage rate. The Chinese economy does not appear to be doing very well, and house prices, the diffusion index, reminder 50 is neutral. So nobody thinks Chinese house prices are rising. So the other big news this week was that after quarterly earnings, in which US banks had to write down a lot of their CRE loans, their loss reserves are now lower than delinquent loans. But it's questionable how much of a problem this is, because the US banks are just making vast amounts of money at the moment on high interest rates. And Bank of America's chief executive, Brian Moynihan, said in December the bank had identified $5 billion in CRE debt. which are problematic and which is tiny for a bank which earned 30 billion last year.
I guess it depends, doesn't it, on the size of the bank? So clearly,
Yeah,
Bank
it
of
could be.
America is a different kettle to the fish to a lot of these smaller regional banks who've got a lot of exposure to CRE.
Yes, that's right. And reminder that the bank term funding program, by which allowed all these small banks to access cheap funds from the Fed and prop them up, that comes up for renewal or cancellation next month. We'll see what they do. And on to this week's economic data. Now, the quick summary: UK is weak and stagnant, but showing signs of bottoming, as is the EU. The US is strong, but actually the latest real-time data shows that the rate of growth appears to be slowing, as we have been expecting. China, very difficult to tell. Richard, UK.
Thank you, Keith. So the UK S&P Global Manufacturing PMI is trucking along between 45 and 50, and it's not great. As Keith said, is the UK's definitely slowed down. Is it bottoming? Question. And global services PMI is looking quite a lot more healthy, and as we know, it's a bigger part of the economy, and that is sort of happily between 50 and 60, not showing signs of falling off. And all, I mean, the consensus expectations versus actual results are all pretty close, aren't they, Keith?
Yeah, so it's odd, this, in that the composite improved, but manufacturing barely improved, and it remains in recession.
Yeah.
And the services was flat. So how come composites gone up? Not sure. But the other thing to remind everyone is that we report this every month, but there seems very little relationship between the PMI and GDP, frankly, as we discussed last week.
Yeah, I would agree. UK PSBR had a superb January, positive 17.6 billion, which apparently is due, partially at any rate, due to the fact that we've all had our allowances frozen, but our pay has gone up. So Jeremy has taken a larger slice of the pie, and I'll say it again, the UK is the most taxed that it has been since the Second World War, and in my view, that's a disgrace and a disaster for the economy.
Mm.
And I doubt that figure is going to stay positive for the rest of the year. I mean, January is the tax receipt month, isn't it, of the year?
Yeah. Well, that is an absolute certainty, Richard.
And the January number was slightly worse than forecast. The PSBR is undershooting the OBR, Office of Budget Responsibility. So the OBR forecast is the dotted line, and the actual is the green line, which means that the performance of the requirement for debt in the public sector is greater than the OBR forecast.
Yeah. So you know that Jeremy Hunt is going to, try and close that gap basically in the budget next month.
Yes. Well, is he going to have a giveaway because he wants to win the next general election, right, and then they'll take it back the week after I mean, I don't think they will win the election, but on the basis that they do, the plan would be to take it. But not that they're cynical, or indeed me. So debt interest is falling with RPI, and that's quite interesting, isn't it, Keith? It's rolled over quite substantially, actually, in the last 12 months.
Well, a third of UK debt is index linked. So as RPI comes down.
Yeah.
So,
I mean, we're still massively above the 50 to 60 billion pounds a year that we were in the late teens.
Yeah.
And the UK CBI industrial trends, new orders, I mean, it's just not looking very healthy at all, is it?
Mm. But
it's up on the week, on the month, but
yeah,
up from a very low place. So the GfK consumer confidence, consumers aren't very confident. I mean, they haven't been confident since 2016, have they, Keith?
No.
Makes you wonder, where the baseline of this, where the real baseline is for this data.
That's true. But I think the important thing is that in February it fell back again.
Yeah.
Yeah.
And the Citigroup Economic Surprise Index is actually, I would concur with Keith here. This is not looking great, is it? The economic surprise is definitely on the downside here.
Yeah, but actually, I'm just really puzzled by this because I'm just not sure that the UK data looks that bad, and has been undershooting.
I mean, one of the questions is how do they weight a surprise? I think we discussed this the other week.
Yeah, I don't know. Anyway,
Do they have big surprises and little surprises? And who decides what's a big surprise and what's a little surprise?
yeah, well, I agree with you on that, Richard.
And who decides what's a good surprise and what's a bad surprise, actually?
We have this discussion every week anyway.
Job postings on Indeed continuing to decline and are now below their pre-COVID levels. Suggests that the job market may be slowing, and UK true inflation unchanged from last week, 2.5%, which is low. So we've got a bit of a mixed bag, haven't we, Keith? Manufacturing remains in recession, but services continue to expand, although not strengthening. Yeah, and PMIs don't really seem to have a particularly direct link to GDP, which we know is just slightly negative for the last 2 quarters. I like the way that commentators call it a technical recession. I mean, it either is a recession or it's not, isn't it?
Yeah.
And we have some suggestions from the OBR that Jeremy will have some room for tax cuts in the budget next month, pre-election bonanza for us all. Labour market is probably weakening, and inflation looks like it's heading towards the target. So the UK economy is not firing on all cylinders. Undoubtedly, it's a bit of a sorry state, but it seems to be just chugging along.
Yeah.
The issue, I think, one of the issues is that GDP per capita is falling.
We've got a special section this week on UK productivity, exactly on that point. So we'll save that conversation to a bit.
Indeed.
Okay, and on to the EU. Not much data this week, but the manufacturing PMI got worse again, down 46.1, not great. The services PMI, though, ticked up to neutral. So that meant this composite rose to 48.9, up on January, still in contraction territory, but has definitely appears to have bottomed. This was good. Construction output rose year on year. It was expected to fall. It actually rose. And it rose by 0.8% month on month in January. So has construction output in the EU bottomed? Consumer confidence rose, but that's trivial. Still poor. The economic surprise index, positive. So the picture is the EU economy is weak, but may have bottomed. We also had wage data. So negotiated wages for Q4 came in largely on expectations. So in summary, EU economy is in recession, but appears to be bottoming, ?
Yeah.
On to the US, Richard.
The US Conference Board leading indicator month on month. So that, I mean, it has stopped falling, but it's a pretty low level, isn't it? And the year-on-year real change in GDP is going along very nicely, thank you. So we've got a bit of conflicting information here.
Yeah, well, it's been slowing for a year, and the US economy's been doing great guns. So
and the January fall was mainly due to poor manufacturing new orders and drop in weekly hours worked. So the LEI is no longer forecasting a recession, with six of the 10 components rising. Although the rises were a lot smaller than the falls, weren't they? Which is probably why it still looks very, very negative.
Yeah, I mean, the trouble is that the leading economic index has just been far too pessimistic because it's weighted very much towards manufacturing when US economy is increasingly services orientated. And consumer, it's also got this big weighting to consumer confidence. And consumer confidence just everywhere seems to have taken this structural down leg after the pandemic. So
Yeah.
it's just way too pessimistic. But the
Yeah.
other thing is that it does have this the biggest contributor to, positive last month was the S&P 500. And, as long as equity markets remain high and a very financialized US economy, that's, very good for people's finances and consumer confidence.
Yeah. And Conference Board has withdrawn its recession forecast now. So
Yeah.
it feels that the US is going to have a soft landing.
Yeah.
So the US global manufacturing PMI is bouncing above 50 now, better than expected, and looking quite positive actually.
Yeah. Definitely on an upward drift.
Yeah, and the services PMI is maintaining its sort of above 50 level, and its behavior isn't actually that dissimilar to the late teen years if you go back pre-COVID.
Yeah. But it's weak. And, we've been talking about how the US economy is strengthening, and then that's not a great number.
I suspect we've still got a lot of contradictory data in the US. Okay, so the US global composite PMI is above 50, fallen back slightly in the month, but still signaling growth. The Chicago Fed National Activity Index, though, is down. And if you look at that chart, it's been down for most months in the past year. And the downs are also bigger than the ups. So this is suggesting that the US economy has been and is continuing to slow.
Yeah. But, so reminder, these are in standard deviations from the mean. So the trouble is that, we know the US economy did really well last year.
Yeah.
So, I mean, it's suggesting it's slowing down, but nowhere near recession.
US PPI month on month is at 0.3%, which is significantly above consensus expectations, actually.
Yeah, not great. Bond market took this very badly.
Yeah,
It's a sign.
yeah, and if you annualize it, it's about 4%, isn't it?
Yeah.
Roughly speaking. And the year-on-year PPI, I don't quite understand. Well, yes, because the year-on-year change is it's not the annualized month-on-month, 0.9%, which is actually quite low, although it was worse than expectations.
Yeah.
But I think the expectation must be now that this is going to pick up.
Well, more on that in a bit.
So the US core PPI year on year just ticking up to 2%. But if the month on month is any indication, that's going to go up more. US housing starts are down, and this certainly looks like it is now has formed a top and is heading downwards.
Yeah, the thing is, January there was winter storms. It could have been just cold, frankly.
Yeah. A few more months data required.
Yeah.
US building permits I would say, look to me to be leveling off now.
Yeah, at a decent number though.
Yeah. And existing home sales are pretty low still. Have they bottomed? They need a bit more data there. And the Michigan consumer sentiment is, again, what is the baseline here? Because you would say really the baseline is about 80, wouldn't you? And if that just sort of eyeballing it,
yeah,
80 would be neutral then.
Yeah.
But anyway, there's an improvement there. Michigan current conditions significantly improving over the last few months. And Michigan consumer expectations, sudden jump up. That's a big jump.
Last couple of months, yeah.
Yeah. Yes, indeed, yeah. 1 year inflation expectations are really quite low, 3%. 5 year inflation expectations actually pretty similar, aren't they? Population seems to have settled into a 3% annual inflation rate. Redbook retail sales, they fell towards the end of, in January, probably seasonal. And they're just picking up a little bit in February, this week even. The 30-year mortgage rate is still moving between 6 and 8%, so at 7% currently. That's pretty high in comparison to what it has been. So you'd expect the housing market to be under some duress. And the mortgage market index it picked back up a little bit, didn't it? It's now dropped back down again. So the
Yeah.
mortgage market index is looking very sick still. Initial jobless claims, nothing to see here, I think you would say. The economy looks fine.
Yep.
Continuing jobless claims, a bit higher. Unemployment maybe a little bit more sticky, but again, nothing particularly dramatic. And the year-on-year change in the unemployment rate is falling.
So again, it just doesn't seem like there's the unemployment rate is rising particularly, and you've seen that, the red line indicates generally when a recession starts to develop, there's little risk of that.
Yeah. So the Dallas Fed weekly economic GDP estimate is 1.8% this week, 2.3% last week. So that is a nice positive number. And the Atlanta Fed GDP now of quarter one is 2.9% currently. So these are all suggesting the economy is still growing strongly.
Yeah, good numbers, but weaker.
Yeah. And the economic surprise index is above zero. And indeed, in the US is also reporting continuing declining job posts. Of course, whether that reflects Indeed's popularity or whether it reflects the job market or a combination of the two, difficult to tell.
Very true.
Trueflation 1.7% and still falling. And the US federal budget deficit in billions is currently 1.7 trillion, and it is on that continuing its sort of general downward trend that it has been on since the turn of the century, really.
Amazing.
So where is the US summary? So manufacturing strengthening, services a bit of weakness, producer price inflation is high, no sign of unemployment, no problem with unemployment, and the US economy is still looking strong with good GDP. So interest rates haven't yet slowed it.
Yep. And on to China. Very little data this week, but we had the foreign direct investment number out this morning, and it's really bad, actually. So it was expected to be bad at -6% year on year. It came in at -12% year on year. Chinese house prices met expectations, down on the month, but I just don't believe these numbers. I think the fall in Chinese house prices is much lower, much worse. Economic surprise index actually turned positive, but very close to zero. Now, this is from the IEA, and we've got a section coming up on China, but I thought this was very interesting. So if you look at the properties under construction, which is the green line, and the new floor space started, which is the purple line, you'll see that new floor space started has completely collapsed. And so the construction market is being kept active by all these properties they started years ago and now have to finish. But eventually, construction activity will collapse towards the purple line. This is FDI, lowest in 30 years. And that's actually before today's number. And the reason they have cut interest rates is that people are not taking out mortgages. Demand is low. So bottom line is, the numbers are very difficult to interpret. I particularly don't believe the house price number. But it seems that the Chinese economy is not doing well currently. And on to one chart. Now, we have been talking about US inflation and how it surged in January, and is very important for the outlook for inflation because that drives interest rates, etc., etc. Now, actually, there is very strong seasonality in US inflation numbers. If you look at the red line, the red dotted line is the seasonal average of US inflation between 1984 and 2021. And so you'll see this chart covers a 3-year period. And in each of those 3-year periods, the red line is exactly the same. That is the seasonal average. The blue line is actual US inflation numbers over the last 3 years. And you'll see that US inflation shows the seasonal pattern of being high early in the year and then drifting off over the course of the year. So that has implications because it's likely that February will also be hot. And then inflation will drift off over the course of the year. So that implies the Fed is going to be dealing with higher inflation numbers in the first half of the year, and rate cuts are likely to be delayed. Now, I have taken the ONS numbers for UK CPI, and I've looked at seasonality in UK inflation numbers. And there is also strong seasonality in UK inflation numbers, but the seasonality is entirely different. Whereas in the US, you have strong inflation numbers at the start of the year, in the UK, January shows strong disinflation. Now, reminder, last week we reported that UK CPI fell 0.6% month on month in January, and that is very much in line with seasonality. The bad news is we now go into a 4-month period which contains probably the most inflation in the year according to the traditional seasonal pattern. So on average, February has inflation of 0.45%, March 0.33%, April is the worst, 0.66%, although you'll notice the median is lower than the average, implying that April is distorted by some big years. Presumably that is wages resetting and prices resetting for the new tax year.
Yep.
Now, we've shown you this chart before, and this is UK CPI month on month over the last year. And reminder, January came in soft, minus 0.6%. Now, if UK inflation were to revert to average, then over the coming 4 months, then by May, UK inflation would hit the Bank of England's target. So the next few months are going to be crucial. Expect inflation to be higher than it has been over the last few months because of the seasonal effect. But if it comes in close to its historic average, then the UK is on track to hit 2%. And now we're going to have a discussion on UK productivity. Now, we talked about this last week. UK labour productivity has been very poor for years, frankly, underperforming its peers. And in the last year, it shrank by 0.7%, which is weird. And the UK added about 100,000 jobs last year, but GDP stagnated, so labour productivity fell. And actually, this has been a problem for years. So this chart is back from 2020, and it shows that labour productivity pre the GFC was much higher. So it seems as though there was a step down in UK labour productivity after the great financial crisis. So this chart shows UK labour productivity by sector relative to Q3 2022. And notice that there's a big drop in labour productivity in the finance and insurance sector, which frankly, I think you would expect because as the economy is slowed, so you get less loan growth and also less IPOs and M&A deals. And if you think the banks have, retained staff, then their productivity will have gone down. So what's weird is that in the last year, the number of UK payrolled employees rose by 400,000. That's a rise of 1.3%. But GDP fell by 0.1%. So we've been adding more employees to produce less in terms of goods and services. Okay, so thank you to our Discord community for us discussing this during the week, trying to work out what's going on. Well, so what are the possible explanations? Number one, bad data. Well, the Bank of England Governor Andrew Bailey was complaining about the lack of data this week and how he didn't even know what the true level of unemployment was. So that is certainly possible. Second option, workers are becoming less productive. I think we can rule that one out. I think basically people, don't forget how to do their jobs. Number three, labor hoarding in key sectors. And I think that is true in the finance sector, where essentially output has fallen less than the staffing levels. Number four, the UK could be adding jobs in low productivity sectors and losing jobs in high productivity sectors. But the ONS has specifically ruled that explanation out and stated that the opposite has occurred. So job gains have been primarily in higher productivity sectors. Number five, the gain in jobs has improved the quality of services, not their quantity. And remember, quality is not well measured in GDP, only quantity is. And that is a particular issue for the healthcare sector, which saw some of the largest net job gains last year. And finally, and Richard, this is one of Richard's bugbears, regulation is forcing companies to hire lots of unproductive workers in the form of compliance officers, diversity officers, etc., who add nothing to output but increase cost. What are your thoughts, Richard?
So I think all of those solutions are possible, aren't they? There's an indication that the government, the public sector, is the largest it's been effectively for many years. The public sector does not have the efficiency. It doesn't actually have an efficiency driver in the way the private sector does. The private sector is constantly investing to improve efficiency. Public sector, I don't think, is. And I think the public sector, particularly these days, 0.6, has fallen over itself in terms of political correctness. To what extent that would impact the sort of global GDP for the UK, it's difficult to tell. Clearly, there must be some lack of investment in improving our productivity. I think the fact that we've added 400,000 workers for a loss of GDP is a disgrace, and that says that the economy fundamentally is being badly mismanaged. And my view generally is that we have a very interfering state these days, and an interfering state inevitably leads to a drag on the economy because people involved in making the decisions aren't directly affected by the consequences of their decisions. And you can take, for example, I think this is quite a good example. If you look at nurseries, so the nurseries, the regulator stipulates what the staffing level is. There's no cost to the regulator for that stipulation. And then the government stipulates what they'll pay a nursery. Yeah. So the nursery is effectively stuck in between a rock and a hard place. But if the regulator stipulates a higher staffing level, productivity drops. Yes. It doesn't rise. And as far as the regulator is concerned, their risk is someone criticizes them, and they'll be criticized for not ensuring safety rather than for ensuring it. So we have this push, and the larger the government sector gets, the bigger the push becomes that everybody has to be safe and nobody can be criticized. Whereas the private sector rather takes the opposite point of view. It will risk it, and it will deal with the consequences if it has to.
Yeah, very good point, Richard.
But I think it's a structural problem in attitude
Yeah, the nanny state. And this has been under a Conservative government who should be, pro-free enterprise.
Yeah, well, the Conservative government has completely lost its way, hasn't it? Because you look what's happened to the economy in the 13 years, or however many years now it is, that we've had either the Conservative or the coalition government,
Yeah.
and they have completely lost their way.
So these are jobs in the finance sector, and you see they have held up over the last couple of years. So, output is almost certainly declined because people are taking out fewer loans and there's much less M&A activity, etc. So that is certainly part of the problem. And we've talked about this before, but the gross value added of UK financial services peaked in the great financial crisis when UK banks and speculators were essentially taking money from the rest of the world very efficiently, and now they've been regulated and can do much less of that. And this is the growth in employment over the UK by sector over the last year, and you'll see there has been a big increase in the healthcare and social services sector, which it's difficult to measure. If you add a social worker, how do you measure their output? Not sure. But this is the US, where labor productivity has grown very strongly over the last couple of years. So the UK is not doing well. Will AI come to the rescue? Because AI is forecast to strongly boost the productivity of the service sectors in which the UK excels: professional services, admin services, information, agriculture. No idea. Well, in conclusion, it's a puzzle. But I think Richard's point about the smothering effect of the nanny state is probably a good one. And on to inflation watch, Richard.
Thank you, Keith. So there's no new data. FOMC meets 19th, 20th of March. Bank of England 21st of March, ECB 21st of March. So really, it's got all quiet on the Western Front as far as central banks are concerned for the next almost month.
Yeah, and all of them have come out basically saying don't expect a rate cut in March.
Yeah. And fewer businesses planning to raise prices in February than a year ago, which suggests that we have continuing disinflation in the UK, which is good news.
Yeah, let's hope so.
Services inflation in the UK was 6.5% in year to January, which is an awful lot, driven by restaurants, housing, and package holidays.
Yeah,
restaurants and cafes.
I was amazed by the, when you look at this contribution to inflation, the restaurants and cafes, dwarf everything else.
Yeah, I think. What do I think about that? Well, first of all, I think from personal experience, you buy a coffee in London. It used to be 2 years ago, probably it was £2. Now it's £3.50.
Yeah,
I think they've been hit by energy prices. I guess they're very sensitive actually to pay rates.
Well, I would say, Richard, that I have been pleasantly surprised by the price of beer in pubs recently. I think it's actually come down. Right. Yeah.
How much?
Well, so it's still absolutely ludicrously insane, but I've become used to paying over £7 a pint.
That is a great deal of money.
Which is ludicrous, but I've noticed recently it's back under £7. And, let's face it, energy costs have absolutely collapsed. Yeah. And so they should be passing on some of that reduction in cost to their customers.
They should do, shouldn't they? Yeah.
So this chart shows the CPI component for restaurant inflation, because, restaurants were clearly a huge component of service inflation over the last year. So I thought I'd just have a look at it. And it seems to have leveled off over the last 3 months. But, and there's a huge but coming, there's a very strong seasonality in restaurant prices. And January, so if we annualize the 3 months to January, you only get inflation of 3.2%. But, we talked you through the seasonality in UK inflation. That absolutely applies to restaurant prices as well. So we're just going to have to wait and see what happens over the next few months.
the US owner equivalent rent should be following rents and house prices down in the coming months. So you can see the owner equivalent rent is still very high, whereas the rates of inflation for those other indices have dropped away quite dramatically.
Yeah, and reminder, OER was a big reason for the beat in US inflation in January. It rose sharply, which is just weird.
So Invitation Homes, one of the largest institutional landlords in the US, are reporting steadily falling rental price inflation. So have a look at that. I think quarter 3 2023 blended was 6.2. This quarter, quarter 4 it was 4.6. So it's dropping quite quickly.
Yeah. So that should also add to the picture of OER should be coming down.
Yeah. And indeed, US wage growth is falling steadily. Presumably they do that on the basis of prices, wage rate, pay rates advertised.
Yeah.
And it's falling across different wage tiers, low, middle, and high wage. The rate of inflation is falling across all of those.
Yeah.
Yes, inflationary pressures are falling away. But it does remain high in Europe. Well, relatively high, actually, because it was never that high, was it? It only went up to sort of 4%, 4.5%. Never as high as the UK or US, I can put it that way. But it's not falling away as fast either.
Yeah.
Well,
It's interesting the pattern here in that US wage inflation peaked well before the UK.
Yeah.
UK is only just coming down.
Yeah. And the US PMI output price is consistent with further falls in inflation. And a typical UK energy bill is due to fall by £238 under the new cap, which was announced today, wasn't it?
Yep.
So this is hot off the presses, Keith. Well done.
Yeah. Yep. So that should also help in bringing UK inflation down.
So inflation appears to be falling, and well, it is falling, and the future appears to be consistent more falls. But we have to watch out for seasonal effects that determine the path of inflation over the next few months as well. So remains to be. So you can understand why the central banks are being careful, because they've got their fingers really badly burnt.
Yeah, I completely agree. Okay, and while we talk about inflation, let's talk about US inflation, because when we talked about this last week when CPI came in hot. Well, when you look at the big components for year-on-year inflation in the US, the biggest one was transportation, which is really weird because we know the price of motor vehicles is falling, both new and used. Fuel prices have been falling. So how come transportation inflation was 9.2%? Well, it all comes down to insurance.
Right.
So insurance has risen 20% year on year.
Wow.
And by 85% over the last 10 years. So what's going on? In 2022, the US car insurance industry lost money. It had a combined ratio of 112%. So for every pound it took in, so every dollar it took in, it paid out $1.12. And so hence they have raised premiums in 2023. And frankly, their forecast is they will raise them again in 2024. And so in January, US car insurance premiums rose again. And the reason the industry is losing money is that there have been more crashes. And it is thought this is due to mobile phones. So people are fiddling with their phones, not paying attention. So they're having more crashes. And also because they're not paying attention, when they do crash, they haven't reacted and they're crashing at full speed. So go on.
Does the US have the same rules about using mobile phones in a moving vehicle that we have?
Actually, that's a good question. I imagine they do. But, People are ignoring them. There are also higher thefts, and which we know in the UK, from people in my street wandering around in the middle of the night with these radars, or so these devices to intercept the
Yeah,
signal between your car and your keys.
yeah,
And also, repair costs are much higher for electric vehicles. One of the ways that Elon Musk has reduced the cost of Tesla is that the whole of the chassis is made from a single sheet of aluminium. So when there's a crash, it's very, very difficult to repair, basically.
right.
So, bottom line is that US car insurance inflation is the biggest contributor to transport inflation as a result of behavioral changes, and is expected to continue. And that will drag US inflation higher in the coming year.
Yeah. Well, it's a genuine price pressure.
Yeah. And on to China and the energy transition, Richard.
This chart on the left-hand chart shows that is a projection of the Chinese working age population, and the dotted line shows the projection of what is effectively over the next 25 years, and how that is going to impact steel production and cement production. And you can see we have these massive declines over the next 25 years in particularly coal and steel commodity markets, commodity demand, but clearly in other commodities as well. What impact is that going to have on commodity markets globally? I think is the question. Very difficult to tell. What's the right-hand graph showing?
Because the Chinese energy demand will be declining, their investments in clean energy, which is the green bars, mean that they can cut their fossil fuel consumption hard. So this chart shows that China is massively investing in solar photovoltaic panel production. The bars are planned output capacity, which is stepping up enormously. And if you think that in 2020, it was what, 350 gigawatts, then by, was that 2027, 2026, it will have pretty much trebled it, more than trebled it. And we reported in previous weeks how China has already met its target for renewable power generation, that it's for 2030, which is only set in 2020. So it's massively outperformed its commitments, actually.
So that then leads to a big decline in coal required for electricity generation, which will begin shortly.
Yeah, hopefully.
And demand for critical minerals for electrification technologies is going to be significant, isn't it? So we've got massive increases actually in demand for copper,
Yeah,
silicon for photovoltaics, rare earth elements for magnets, lithium for batteries.
yeah.
Massive increase in demand for those.
Every year, the IEA produces this World Energy Outlook. And this shows you how it has estimated global renewable power generation over the last 5 years. And you'll see that there's been this exponential increase over the period.
Solar is now the cheapest of the renewable technologies. And you can see there on average prices for solar panels, this is per US dollars per kilowatt hour, solar panels. Wind turbines, EV batteries have fallen fast, but appear to have bottomed. And wind turbines have bottomed. Battery storage looks like it's bottomed. So actually, the cost of all these things appears to have bottomed now.
Yeah.
As has the whole index.
And this chart is a very complicated chart, but the thing to take away is that in the right location, then renewables can be the cheapest form of power generation. And that's surely good news.
So all of this is good for solar photovoltaic prices in the energy transition and increase increased economies of scale for Chinese manufacturing, or clearly they've come through, haven't they? It's good news. Well, the demand for key commodities in solar, which is polysilicon, silver, copper, aluminium, those metals. And bad news for coal demand and prices in terms of energy generation. And bad news for non-Chinese solar voltaic manufacturers because they can't compete. And bad news for the Australian dollar, presumably because it's a massive exporter of coal.
Absolutely. Thank you, Richard. I mean, actually, the key takeaway from those charts for me is just how much Chinese workers, the fall in Chinese workers in the next 25 years, that's going to have absolutely enormous implications for the global economy.
It is.
And, you know, for commodity consumption of all kinds. Okay, and now we're going to go through global oil production country by country, which we do every 3-4 months or so. So last year, global oil production actually fell in the year to October, entirely due to the OPEC cuts. So OPEC reduced their production in the course of the year by 1.35 million barrels a day. Non-OPEC increased their production by 1.18 million, and that was largely due to the US, which increased its production by 870,000 barrels a day, but also Iran increased its exports, as did Brazil and Kazakhstan. So if we look at if we look at predictions for global oil output, they're expected to rise in the next 2 years by a total of 1.4 million barrels between November 2023 and December 2025. But note, this is below its pre-COVID peak because of the OPEC cuts. And if we look at the world ex-US, then we are well down on pre-pandemic, and it's expected to grow a bit. Or if you look at it another way, this is the big three: Russia, Saudi Arabia, and the US, and output has gone nowhere and is well down on peak. And I thought this was really interesting. This is the rest of the world, ex the big three, and steadily climbing back from pre-COVID, but nowhere near peak. And if we go through this, I think that is largely due to the other OPEC members not returning to output at full capacity. So let's go through the non-OPEC members first. This is Angola. It's drifting down. It has left OPEC in December because it wants to reverse this fall in production. It's hoping to attract Chinese investment and return to previous highs, but that will take years. But it's very interesting that Angola feels that it is better off outside OPEC because it wants to increase production. This is Brazil. Brazil's production has grown strongly over the last couple of years, but they're forecasting it will now only increase by 100,000 barrels a day in 2024. The EIA is forecasting that its production will be flat. So the growth seems to be petering out in Brazil for now. This is Canada. Haven't got a forecast, but it's hitting new highs as of this month. China, actually for the last 5 years, in January, Chinese production has leapt, but not this year. So this year, Chinese production is expected to be flat. Guyana is a big one. Now, I haven't got actual production numbers for Guyana, so these are the forecasts. EIA reporting that in 2023, Guyana was producing 430,000 barrels a day by the end of the year, and that's expected to rise to 600,000 at the end of 2024, a rise of 170,000 barrels a day, or about a third. But you see the forecasts are it's going to keep on growing over the next 6 years. And that will be a huge contributor to global oil production. This is Kazakhstan, looks broadly stable. Mexico is in trouble. So Pemex, the state oil company, has suffered from underinvestment. And this year, declines are expected to outweigh new production, leading to a fall in production around 120,000 barrels a day. Norway, actually, I'm surprised by this, still growing, expected to rise by a further 120,000 barrels a day in 2024. Oman is a signatory of OPEC Plus, despite not being in OPEC, and it has clearly complied with the cuts. Qatar, again, is not actually a signatory to the cuts, nor a member of OPEC Plus, but it's clearly constraining production below capacity. Russia, who knows, frankly. The EIA currently estimates that Russian production has been largely unaffected by Western sanctions, and they're forecasting that Russian production grows by just 40,000 barrels in 2024. And this is US, and the EIA are actually forecasting that US oil production will fall by 300,000 barrels a day in 2024 before rising again in subsequent years. And then we have 6 more producers, including the UK, whose production is in long-term decline, although that decline actually, when you look at the scale, is relatively slow. Okay, so moving on to OPEC. This is the OPEC 12, and their production is well below pre-pandemic levels, entirely due to their intentions. So they've cut. They've got around 3 million barrels of spare capacity. And this chart, please take a look. We reported this last week. So it got the OPEC plus quotas, and the column on the far right shows which countries are complying and which are not. Iraq is outproducing its quota by 270,000 barrels a day, Kazakhstan by 90,000. But there are lots of countries that are failing to produce their quota due to production difficulties, including Russia and Sudan. This is Algeria. Algeria has complied with the cuts. Congo is in slow decline, but it's tiny. Equatorial Guinea declining and tiny. Gabon actually rising. Now, Iran is exempt from the cuts. Output has grown substantially in the last couple of years. It is subject to US sanctions, and in November, the US passed a bill to tighten US sanctions in the aftermath of Hamas's attack on Israel. But Iran is successfully evading sanctions. And over the last few years, you see that Iranian exports have taken off despite US sanctions. And now, almost all its exports, 91% of its exports, go to China. So we've talked about this before. US sanctions are just increasingly ineffective.
Yeah.
So this is Iraq, which is a signatory to the OPEC plus cuts, but is currently cheating, outproducing by 270,000 barrels a day. Kuwait appears to have complied. Libya is a mess. So its production fell by around 100,000 barrels a day actually 200,000 barrels a day in January due to renewed unrest. It's got enormous oil reserves. Its oil reserves are 320 years of current production. But the question is, can it get the investment to up its output? Answer, not while the country is a total mess. Nigeria is really interesting. So Nigerian oil production has actually bounced back over the last 18 months. And the oil ministry has set a goal of lifting oil production from its current, they say 1.8 million, S&P Platts say 1.5, to 2.6 million barrels a day by 2026, i.e. in 2 years' time. Now, Nigeria are a signatory to the OPEC plus cuts. So it's actually, they're a member of OPEC, so they're signatory to the OPEC cuts. And what are they going to do? Because if they want to increase production, they're going to have to leave OPEC, just like Angola. Watch this space. I suspect the money is more important. They're going to want to increase production if they can. Saudi has complied with the cuts. You notice its production is the lowest it's been outside the pandemic since 2011. UAE complying with the cuts. Venezuela. So US eased sanctions on Venezuela, but its production has barely lifted because it takes years to invest in new fields, etc. And currently, the Venezuelan government is kind of not really complying with the terms of its agreement with the US. And the future outlook there is highly uncertain. What does that add up to? Well, the EIA believes the oil market will be in deficit for the first quarter, but then return to surplus for the rest of the year and for 2025. So that is not a great outlook for the oil market. The OPEC is currently in control. It's got 3 million barrels of spare capacity, but I doubt that it will be able to increase that much because it is the compliance is already stretched. Various countries are cheating. Angola has left OPEC in order to grow its production. Nigeria could well do the same. And Guyana is going to be a big source of production growth in the coming years. Richard, you got any thoughts?
Yes, I mean, there's this competition, isn't there, between them all? But OPEC is secure, but if they want to increase their production, they have to go outside of OPEC. China's a bit of a wild card, and it wants to secure its supplies. It wants to be basically independent of any US control in its supplies, which encourages people, producers, to move outside OPEC. And as you say, global oil demand, the global economy is growing. So whilst we're putting in place more and more renewables, the oil demand is remaining reasonably, it's shifting up but fairly slow. It's not changing terribly quickly, and it's all tied in with all of the various geopolitics. And it's interesting that Mexico sort of has underinvested. It's like it's killed the goose and laid the golden egg, hasn't it?
Yeah.
And that's what happens perhaps when you get bureaucrats involved in it sometimes. So I think, I mean, it's fascinating, isn't it? It's like there's this sort of constant moving around of production, who's making what and so forth. There's plenty of oil, actually, there's plenty of oil around.
Yeah.
And the individual pieces move around, but the totality of it seems to remain fairly constant.
Yeah, very true. Well, production could be, substantially higher than it is, basically. It's just Saudi. Another way to look at it is that currently there's too much oil.
Yeah, and there's certainly peak oil, which
Yeah.
people have been predicting for a long, long time. I don't think it's ever going to happen.
And on to recession watch, Richard.
So this is in the US. Retail sales are in recession, having fallen 0.2% in absolute terms, 3.2% in real terms in the year to January, which is quite a substantial fall in real terms.
Yeah, I was surprised by this, actually.
Credit card interest rate continuing to rise, is now 21.4%, which is an awful lot. That finally appears to be denting demand. Presumably, people don't pay off each month, and they find that the amount of interest they're paying is unaffordable or very difficult to manage.
That's it.
Yeah, so But it's interesting. It's a big drop in retail sales.
Yeah.
The US economy as a whole is still going great guns. So are we going to have a soft landing? So the US unemployment rate has not picked up due to labour hoarding, and the historic relationship between earnings and hiring plans has completely broken down. So we've got this hiring plans in red and actual earnings change. So hiring plans are remaining quite strong and earnings are falling, which means people are not having to increase rates to attract people to come to them. And here we have hiring plans again next 3 months, whereas the actual employment changes, and the relationship's broken down a bit, hasn't it? I think probably COVID is responsible for a chunk of that, and actual hiring is weaker than hiring plans at the moment. And warn notices, which people remember, is what businesses have to give if they're larger businesses and they need to make I think over 50 employees redundant, I think.
Yeah, something like that.
They're not rising, so...
Well, sorry, they are rising, but they haven't resulted in an increase in jobless claims.
Yes, are rising, but the jobless claims are not rising. So whether there's a sort of a partition between different types of company and their employment, difficult to know.
I really think that we talked about this before. This is puzzling failure to rise of the unemployment claims. I do wonder whether people, when they're laid off, A, don't bother, and B, they just go and get a job with Uber.
Yeah, and then they escape the figures, as you were discussing the other week. So this is showing that global car production has picked up and is continuing to pick up following pandemic supply chain disruptions. Interestingly, isn't it, global car production is almost back to pre-COVID. UK car production is half pre-COVID.
Well, isn't that Brexit? When was Brexit? 2016 Brexit vote?
Yeah, I mean, maybe. I don't know, Keith. Is it Brexit? I'm not saying it's not Brexit, but why was it so precipitate from 2017?
Well, Honda closing their factory, etc., etc.
Yeah, I guess so. Yeah. My memory is a bit hazy of all of that now. So the Conference Board Employment Trends Index, total non-farm employment in red, and the Conference Board Employment Trends Index in blue, which generally speaking, I don't know, they sort of followed each other very clearly, didn't they, from after the GFC until COVID, and now they appear to be diverging a bit.
Yeah, it's picked up again the last couple of months.
Yeah.
And
this is export growth from Taiwan, Korea, and Japan. So they had a bit of a blip, didn't they, in 2023, but they're going strongly positive now, driven by AI chip shipments.
Apparently.
Especially from Taiwan, presumably. We've got some labour hoarding going on in the US. Therefore, the sort of decline in corporate earnings hasn't resulted in job losses. We've got global manufacturing cycle appears to have bottomed, certainly if you look at the car production and the exports from Asia. And global trade is picking up, although we don't really know what's going on in China.
Yeah. And on to other charts. Now, the EV revolution does not appear to be going terribly well in the US. So the percentage of cars sold in 2023 that were EVs has fallen. So rather, everyone was predicting that EVs would be a growing share of car purchases and of the fleet. Well, that's going into reverse. And if you look at the amount of inventories with US car dealerships, you'll see this has been going on for a while now. You'll see the dealerships have got loads of electric vehicles that they are struggling to shift. Now, really interestingly, hybrids appear to be in demand, got very low inventories. And when you look at the costs, the price of these vehicles, you can probably see why. In if the US consumer is feeling a bit pinched, well, electric vehicles are, what's that, 15, 20% higher than hybrids in cost. Hybrids are the cheapest.
There's a clear economic incentive, isn't there, not to buy an electric vehicle?
Yeah, absolutely. And the commentary is that the most enthusiastic, first purchasers have now all purchased them.
Yeah.
And this is really interesting. So thank you to Discord member Ross T87 for sending this. This is UK office planning and construction starts. And it's picked up, which is, really not what I've expected, given A, weak economy, and B, the fact that everyone's working from home. But if you look at the top chart, you'll see planning approvals for offices have, particularly the big ones, over 100 million, surged in the last quarter of last year, although nobody has yet done anything about it. So they haven't actually awarded contracts or started. But it's interesting that they're intending to. And on to good news. Well, Paul McCartney has got his guitar back. So this is a bass guitar he had stolen from Ladbroke Grove in 1972.
Wow.
And so last year, they did a big online appeal to try and trace it, saying if they could find it, there wouldn't be any charges on this 50-year-old theft. And somebody wrote in saying that it had been sold to a pub landlord and was now in an attic in Sussex. So bottom line is he's got it back. And
Excellent.
It's going to be restored and he can start playing it again. So,
Good. That's a nice piece of good news, isn't it? Bit of humanity.
Yeah. It's interesting that it was put in an attic rather than, sold. Yeah. Presumably it's actually worth quite a lot of money, you would have thought. And on to equities, Richard.
So the FTSE All World Equity Index is rising quite strongly from its little November low. It's risen, 15% since November?
Yeah.
And FTSE All Share is sort of following on its 20-year trend of being flat.
Yeah.
The Euro stocks has actually risen strongly since October as well, by again 10 or 15%. 15%. And that's interesting given that we know that Europe isn't in a great economic shape at the moment.
Yeah. Odd.
The S&P 500 has risen 20% in the last 2 to 3 months. It's doing astonishingly well.
Yeah. New all-time high this week.
Yes. Yeah. NASDAQ composite. Same. I mean, we know about NVIDIA and AI and what that is being driven by the Magnificent Seven, but nevertheless, it's doing extremely well. And the Russell 2000 basically says it's risen actually. It's risen about 15% since November, but it rose more quickly and it has plateaued over the last 6 weeks or so.
Yeah.
The Hang Seng is picking up, had that dreadful sort of meander downwards, but it's now picking up a little bit. Has it reached its bottom? And the Topix continues. It's up 30% since this time last year, 40%.
Amazing.
Bitcoin has done well. It seems to be on an uptrend now. It's still doubled since September. I think it recently reached its previous high, didn't it? And it's fallen back a bit. The pound against the dollar is basically in this broad range, and it's not going anywhere at the moment. As is the euro against the dollar.
Yeah. And
as is the dollar index. There's the VIX, which just picked up a bit because there was a bit of a fall off in the S&P 500.
Yeah.
Until the NASDAQ launched back upwards a couple of days ago. And so the VIX bounced up, but I suspect it's bouncing back down now. NASDAQ margin debt. So what this is saying is that margin debt is not what's driving the NASDAQ forwards at the moment.
Yeah.
And this is showing the Magnificent Seven have driven the S&P 500 earnings growth since the pandemic, actually.
Yeah.
And that's very, very marked, isn't it? And non-tech earnings forecasts seem to have peaked, which again is interesting. And the UK market is starting to look more like a developing market, which is not. This is one of the reasons why companies don't want to list in the UK, isn't it? Because it doesn't do well.
Yeah. Well, this is trade volumes, they're just, really low.
Yeah.
So the FT Alphaville had this story about super microcomputer, which makes servers, server racks, and that they were skeptical that the super microcomputer will be, its share price should be shooting up on the back of AI, because it's only tangentially related to AI. And then the moment they would publish that story, shares fell 25%. Well, as of yesterday, surged 30% yesterday on the back of strong Nvidia earnings. So we're seeing that. Are we in some AI bubble? I think where shares are overextended, particularly when you look at stocks like Supermicro Computer, but is not being driven by, excess speculation as seen by the margin debt. And unlike .com, I mean, Nvidia really have had the earnings, amazing earnings.
So if you say that this tech bubble is, if it is a bubble, I think we need to be a little bit careful here, because Nvidia has reported very, very strong results. If you compare it to previous bubbles, then it has further to run. And this is tech is now entirely dominates the US stock markets, tech related at 50%. Traditional cyclicals down 30%, and defensives at 20%.
Yeah.
So tech is the biggest element of the stock markets by a substantial amount. And the top 10 stocks are now 75% of the entire US market. That's market concentration for you, isn't it?
Amazing.
But now 1931 was the
yes.
highest.
Yeah.
Real S&P 500 index periods of zero returns. So it does have periods of zero returns. And when's the next prolonged period of zero returns going to occur?
Question. But, when it's this far above trend, it eventually always seems to return to trend, you'd say.
Yeah. And look at that, between 1905 and 1950, 52 years of zero returns.
Yeah.
There's a lot of movement, but yeah.
Yeah. Okay, thank you, Richard. On to commodities and a quick summary. Well, oil prices were largely unchanged on the week as tensions continue in the Middle East. Natural gas prices continue to fall. The uranium bull run has paused for now. Industrial metals were mixed on the week. Copper and nickel bounced, but most industrial metals fell, particularly iron ore, which fell 5.2%. Precious metals, gold was up slightly, silver down, PGMs had a small bounce. Okay, onto energy. So Brent was up 0.6% on the week towards its recent highs. WTI was actually down a touch on the week, but again, at its recent highs. Numbers specific to the oil market, well, inventory levels in the US were largely unchanged over the week. Crude production was at its peak, a recent peak of 13.3 million barrels, and the rig count was down 2. Now, the IEA are forecasting declining oil demand starting in the 2030s. And they're also reporting that global oil demand growth slowed in January due to stalling demand from China. On to natural gas. Well, the fall in natural gas prices just continues relentlessly. So down a further 9% on the week, down 30% year to date. That's Dutch natural gas futures. Great news for the European consumers and for UK consumers, where prices fell 8.6% on the week, down 29% year to date. In the US, natural gas futures had a tiny bounce on the week, but down 33% year to date. Not good for US natural gas producers. And that fall in US natural gas prices is not due to a fall in consumption. In January, US natural gas consumption was at a record. But if you look at storage levels, this is really bad for the outlook for US natural gas prices. The EIA are forecasting that the glut in US natural gas is going to get worse. So that's very bad for US natural gas producers. Potentially great news for European consumers. Reminder that we have a whole host of liquefaction capacity coming online in 2024. And so that means more LNG cargoes coming to Europe and falling European prices. And US natural gas production continues to climb. On to coal. Coal is unchanged on the week, but down 18% year to date. And the IEA is forecasting that coal demand peaks now. And if that is right, and this is based in largely on the energy transition and China, then coal prices are going nowhere. But the EIA, on the other hand, this is their forecast for coal production for the next 25 years, and they're forecasting no change. So big differences. There's uranium down 1% on the week. Is that a peak or a pause?
Pause, I think, Keith.
On to industrial metals, Richard.
Thanks, Keith. So aluminium is basically going nowhere. It's in a big range, isn't it? It's just going nowhere for a year nearly. And a lot of these commodities will be affected by what's going on in China. It's a little bit unclear, but we know that China is slowing down one way or another. Cobalt, copper making a little run again at that little sort of intermediate top of about 3.9. I think copper is still in structural deficit, isn't it? So always projected to be in structural deficit. So
yeah,
chromium, iron ore, quite a sharp fall since the beginning of 2024.
Well, we've had this mystifying rise over the last 3 months. It's now completely unwinding.
Yeah. I mean, if Chinese construction is going to fall away, then the demand for steel is going to drop fairly significantly, I would think. There's lithium just creeping along the bottom. Neodymium looks like it might be taking another leg down. And nickel. So nickel has been designated by Australia a critical mineral.
Yeah.
Which is interesting. And there's a significant bump in the price just there.
Well, the bounce was due to US announcing more sanctions on Russia, which is a big nickel producer.
Yes. Tin is sort of on this noisy run up from the beginning of from December. And ferrovanadium, not much to say there. Zinc, again, it's just in this range.
Yeah. You going to do this?
Yeah, okay. Precious metals. Gold has been pretty flat now for the last 2 or 3 months, bouncing between 20 and 2050 very roughly, or rather 2000 and 2050. Silver, again, it's in this big, broad range between 21 and 26. That's bang in the middle of it. Platinum is at the bottom end of its range. Rhodium, just doing nothing. Palladium looks like it's continuing its downward trend, I suspect.
Okay, thank you, Richard. On to bonds and rates. So UK yield curve continues to shift up relative to a month ago. Terrible for me, and even worse in the US. People in the UK, inflation is absolutely coming down and is on track to hit the Bank of England's 2% target. In the US, the January numbers were hot, and the US economy continues strong, and the market is rowing back on its expectations of US interest rate cuts. But also, the bond market in the US seems to be having some indigestion with the vast amounts of US treasuries that the US is having to issue to fund its enormous deficit. So we've talked in a previous weekly about how US Treasury auctions work, and the tail. So that is a measure of demand, and basically is the difference between the price at which the auction settled and the average price in the order book. And a big tail means that essentially they had to go deep into the order book to fill the auction. Was the largest on record for this week's sale of the 20-year. Not good. This is the UK 2-year. This is shit. And frankly, I'm getting killed, and we'll talk about this in a bit. But I find this incredibly frustrating in that over the last 2 months, the UK inflation has come in soft, much softer than expected. And the UK economy is not doing well. But average the UK 2-year yield has risen by 60 basis points. So there's been a 60 basis point rise in market expectations for UK interest rates over that period. I realise that there's some term premium, etc. But at some stage, the Bank of England is going to be cutting UK interest rates unless we get a resurgence in UK inflation. And that has all led to a big rise in 10-year and in the 30-year. And I'm getting stuffed. This is the US. Now, the US economy is hot, and they are running a ludicrous budget deficit for an economy that is growing well. So the outlook for US rates is very different from the outlook for UK rates. And this is mystifying. The EU economy, EU inflation is absolutely on track to hit the 2% target. Next week, we get EU inflation numbers for February, and they are going to be, I believe, they'll have a 2 handle. So, EU inflation is falling rapidly. And actually, I think the danger in the EU is that interest rates are too high. The economy is stagnating. I think you could well drive the EU into, a prolonged stagnation. Germany this week cut its forecast for growth to 0.2% for 2024. The EU economy is going nowhere. Italy, go on.
I mean, the central banks do appear to be working in concert, Keith, don't they?
Yeah. In the case of the US, I mean, the trouble with the US is that labor markets are tight, but above all, the US is just running this ludicrous deficit.
Yeah.
Greece. Concluding comments. Well, having talked in previous weeks how PMIs in the US were rising and manufacturing reached a cyclical low, real-time data in the US appears to show that US economic growth has slowed from red hot to merely hot. And we have been talking for many months now about how the US consumer at some stage will run out of excess savings and start to pull in its horns. Is that finally happening? And are we getting the slowdown in US growth that everyone has been forecasting? The equities had a great week on the back of enormous earnings from Nvidia, really very impressive. But the big news, big dominant theme currently is the market is concerned about a possible resurgence of US inflation after strong US inflation numbers in January. Now, we have talked about this, and strong seasonal effects are going to distort the true inflation picture for the next few months. We really have to see what's going to happen in February. If seasonality, the traditional seasonal picture holds, then the February US inflation number could also well be hot. The UK inflation, we now go into a crucial 4-month period where most of the inflation occurs if the seasonal pattern remains the same as it has done in history. Okay. Richard, how are you doing?
Well, I'm sort of doing okay, Keith. So obviously the price of gold, the price of silver is fairly stable, as we just discussed within those ranges. I would very much like gold to go above around about 2060 and stay above it. The mining shares aren't doing particularly well. They seem to be reacting less as you would expect them to do than previously. So that's a bit of a disappointment for me. Obviously, uranium has had a bit of a fallback, and so the uranium miners have fallen back a bit as well. So, generally speaking, I'm hoping things are going to pick up over the course of the next couple of months for my precious metals and for the uranium. I think uranium is at the start of the bull market, but it's sort of a bit near, really, I would say. How about you, Keith? How are you doing?
Well, I'm getting killed, and frankly, I'm depressed. The thing is, when I look at what's happening in the world, we're in disinflation. That should be good for bonds. It should be good for me. This trade should be working, and it's not. It's terrible. And I'm trapped in this. I've gone big in bonds and the expectation that rising rates would kill the economy, leading to cuts in falling inflation and cuts in interest rates, good for bonds. And it hasn't worked. Now, going forwards, I fully expect to get most of my money back when the UK finally starts to cut rates. But in the meantime, every other asset class is going up and bonds are getting killed. And, in the case of the UK, inflation really is coming down. And, by mid-year, we're going to should be at or below the Bank of England's 2% target. And the Bank of England's own forecasts are for, if it keeps interest rates at 5.25%, then both the UK economy and inflation go nowhere. In fact, inflation would undershoot target. So the Bank of England, unlike the Fed, is going to have to cut rates. Now, that should mean good news for me, and actually the bank then stopping QT. And if long yields don't respond and stay elevated, then some sort of yield curve control you would expect, because the UK needs lower interest rates. The economy is stagnating without them. But right now, I'm trapped in this losing trade, and it's like frustrating and depressing, frankly. And I realize that it's an object lesson in how not to invest. But there you go. This cyclical approach that has traditionally worked for me has absolutely not worked this matter. So, for now, this is a very depressing segment of the weekly for everyone involved. And on that depressing note, I think we're done for the week. So thank you for watching. Please can you press like and subscribe to the channel. It's good to have Richard back. And I hope you're all doing better than I am. So
And me.
yeah. So
So,
in the meantime, it's goodbye from Richard Wheaton.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.